Hello everyone, welcome to episode 3. Today is fair value gaps. So, we'll go through what a fair value gap is and then how we can use it. So, let's go on to our daily charts. This is Euro USD, but all the concepts that I'll be going through in the next couple episodes, they all apply to literally every single market, except some markets react better. So, for instance, Forex usually is more prevalent for order blocks, whereas let's say futures like a NQ or ES, which is the futures of Nasdaq and S&P 500, they tend to move really well with fair value gaps and inversion fair value gaps. But today is fair value gaps. I'm going to show it on a Euro USD chart, and let's find a good example of it. So basically, fair value gaps in a simple sense are used as a retracement tool. So what a retracement is let's say I've got my Fibonacci tool. So all this is I'd mark out my low to my high. And if you see here, so this is, actually let's draw a box. So here is my range, right? This here is my range. This is my push up, right? And for whatever reason, gone down at this point. We've reached here, and we've now entered a sell. So as you can see here, we're using our Fibonacci tool. We are now below 50% as we're in a discount range, and that's where fair value gaps will be the most prevalent in terms of when they will work. And what a fair value gap is so we have this long candle here. So a fair value gap is a 3-candle pattern. So let's call this candle 1, this one here. This one is candle 2 because this has the fair value gap in it, and this one is candle 3, which completes the fair value gap. So what a fair value gap is you have your wick here, and your body, and you can see is there a tiny fair value gap there? Very tiny, but there is. But then we have this massive push up, right? And then you have third candle, and you see wick here, wick here. But from this wick, sorry, I'll do this side. From that wick to that wick, there's no wicks in it. There's no, there's just a big gap. And what this is essentially a gap in the market, and it means that this is buy side imbalance. And so what it is, the market will want to come down and fill this gap before pushing up again. So you can see here we've got a really good example with the market tapping into this fair value gap and then pushing back up. As you see, it's a retracement. And this happens, I mean, you can find examples of it everywhere. If I get my brush tool out, where are we? There. So, sorry, what am I doing? I've forgotten how to draw. So, there you go. It's applied here. Here. It's come down, taking the fair value gap, then smashed up. Let's look for other ones. I mean, even here, we're still in that fair value gap, we're still pushed up. I mean, it doesn't show as much here, mainly because we're in a daily time frame. If we drop down, there's more here. See, we've pushed down. Even here, we've pushed down from this fair value gap. They're absolutely everywhere, and they're really strong in terms of trading. So, if we were to, but you can't just, let's say we're down here, and I'm just seeing fair value gaps, and I'm just going to buy or sell whenever I see a fair value gap. Oh look, we've got buy one here, so I might set a limit order to buy there, and oh, I am locked. Why am I still locked? So it might, let's say I'm going to set my stop loss at the bottom here, and you see I'm stopped that instantly because they're not going to work every time. It's all about context. So let's say this was like we'll go down to an hourly, 15-minute chart. How about that? Right. We'll push back. Let's find. We'll go here. So let's say this is the day. We've just had a massive push up. This is our fair value gap here. But obviously we're not interested in that because we've already pushed up and we're no longer in a discount range. And you can see here, this is clearly CPI or some other major news. It's 130. It's probably CPI. On it's a Friday, it'll be NFP. So we're NFP, non-farm payrolls, which is a major news event. It's clearly pushed the Euro USD massively down. See here, we've come into this fair value gap. We're not just going to instantly short the instant we enter in. You can see now that we're in this, our context is we're looking at sells. So here we go, instantly. We've found a fair value gap here, and then we've tapped in, and then we've pushed down really heavily. And that's the sort of way you'd use it. You want to see where is price moving with context. You know, have we swept liquidity? Are we in an hourly fair value gap? Are we in a, I don't know, like an order block on the higher time frame? Then you'd use the fair value gap to help give you an entry model. Let's find a good one. So okay, there might be. Oh no, we'll find a proper sweep and a. Is that double bottom or is that a sweep? That's a sweep. Okay, cool. So there'll almost certainly be one in here. So you can see here, we have swept liquidity. You can see that by just gone below, and obviously we've wicked. So this is Tuesday, the 16th of July. We'll go down to a 15-minute time frame. Tuesday, 16th of July. Here we go. Bang, easy. Knew what happens. You've got fair value gap here, isn't tapped into. Fair value gap here, if we draw it out, where's my rectangle? So draw out our fair value gap. As you can see, we've come in, tapped in, and then pushed all the way back out again instantly. So fair value gaps will be the strongest when they're wicked in and they close out. If the fair value gap you've entered in is wicked and then doesn't close within the fair value gap, you'll be looking pretty good. Also, you've got something called the mean threshold, which is a fancy word of saying 50% of fair value gap or an order block. Well, that would be, you would not want it closing below. So let's say I had, I don't know, my candle here. Let's say I closed below there. I wouldn't exit the trade per se, but I would then be thinking this could be bearish as opposed to bullish. We'll find a bearish example as well. So again, going on the hourly, so we're looking for liquidity sweep. Here we go. So see there, liquidity swap. This is Monday the 15th of July at 4 PM. Where's the 5? Have we got a, wow, that is absolutely perfect, isn't it? You can see this happens all the time, right? This is probably news. 1740? No, okay, I'm on London time, so maybe that could have been like a Fed Chair Powell speech or something along those lines. Probably is the fact how big that wick is. We can see here, easy. We've swept liquidity. What have we done? We've then pushed down. We've created fair value gaps, multiple. We've got a 5 here. We've got a 5 here. Bang. We've got another 5 there. And look, instantly, when this 5 is created, what have we done? We've tapped in, we've only wicked, and then we've pushed straight down. What have we done? Even this fair value gap. This fair value gap is respected. So is this one. They're all respected. If fair value gaps are being respected, that's a real bearish sign. And as you can see, like, well, how much we moved just in pips from here to here? What, we moved 10 pips, easy. Oh no, sorry, it's not even at the top. So what, 13 pips from there. But the whole move is, what's that? 28 pips, almost 30 pips, just from using fair value gaps and liquidity. Super easy. And now what I'll do is I'll show you an example of the 2022 model from ICT. Obviously this is different in the fact that I will be showing a win because I'll just find one. But we'll find some liquidity being swept and we'll let's find, here we go, we've got a sweep here. This probably will work. So as you can see, yet again, all a sweep is a low being taken out and preferably wicked in the higher time frame, but you might not be able to see that easily. But you want a low or high to be taken out and then instantly you want to push in opposite direction. You want a reversal straight away. That will show that the momentum is in your favour in terms of if you're biased towards that reversal. So we are Tuesday the 16th of March. We're going to go down to the 5. Tuesday the 16th of March. Where are we? Lost. Okay, so you can see obviously on the 5, it's a much longer sweep. You know, this is what, Monday at 8 AM, and now we're Tuesday at 7:30 AM. So as you can see, we've swept. So what we'll be looking for now, we'll be looking for a break of structure. Oh, we've already used this, but doesn't matter. This is probably what we're looking for. Doesn't matter. Anyway, so we'll be looking for a break of structure. So you can see here. So the candle that we sweep on is this candle. So now we're looking for a high to be broken. You can see here, we've got a high to be broken. So now we'd be probably looking at the first fair value gap. You can see here, let's say I was trading on a 5-minute model. So we've got a 5-minute break of structure. We've pushed up, and then we've wanted a fair value gap to be respected. So I would have seen this fair value up here, placed a limit order, let's say, we'll put it at the low. And we'd target this liquidity here, which it happens to have already done. We target the internal highs here, so I'd maybe set, oh no, because we wouldn't have entered until this candle. And then, because we've taken, the issue is that we've taken an internal high here before, so I wouldn't have particularly taken this trade. But let's say you did, for argument's sake. You'd then pushing all the way up, straight away you can see the power of fair value gaps. We'll find another one, hopefully, where the internal high isn't taken before we trade. Let's go here. Monday the 8th of July at 2. We're down to the 5 again. We're only doing the 5 because it's more likely there'll be fair value gaps there. Because let's say for when I'm trading Forex, I tend to use the 15 just because I prefer a higher win rate, even if it is lower RR, especially with prop firms. That's just how I prefer. Okay, so let's find a trade using the ICT 2022 model. So as you can see, highs are swept. We've kind of messing about a bit here, so it's difficult to say. So we've even swept these internal highs, which have pretty much been respected. We've then gone a lower high. Potentially they could have been SMT with GU there, but we've obviously not done SMT yet. So as you can see, recent low is there. Have we broke structure? I would say no. You'd really want a candle pushing below that. I wouldn't have taken a trade, even though it's fair value gap. I mean, this isn't respected, but I'm sure there's a 1 minute here that is respected. I wouldn't take that trade. I'd wait for another break of structure, which, as you can see here, so where have we got? That's not a low. That's not a low. That's a low. But then it's not disrespected. But then we've got a low here, and then it is disrespected, as you can see. Right. So now let's say I was trading on the 5. Obviously we've done through this fair value gap, pushed down. We still haven't got any major fair value gaps. Haven't got anything, and nothing ever actually turns up. So Monday, 18th of July. Let's see if there's anything on the 15. Let's see. So we have a fair value up here, but it isn't respected. We'll go to the 30, and if not, it just might not have been. Looks like we've got a fair value gap there. No, so we never actually got into a fair value gap, so that wouldn't have taken a trade there. Okay, let's look for another one that properly works. Where do we want to go? Should we go here? The 26th of June. Oh no, we're not going to be able to get that far back. Actually, yeah, we will. We'll be fine. No, we'll go over here somewhere. Okay, so let's do this. Okay, so we've got this 1 hourly high taken out. We also have this. This will be a new week opening gap. This is not something we're doing yet, but this has been completely filled, which would be very bullish if we've swept a low, even though it is an internal low, and then we've reacted from it. So I would be looking at a buy model here. Tuesday the 2nd of July. Let's go to the 5. So Tuesday 2nd of July, as you can see, that's our massive new day opening gap, but we can just ignore that. We'll just move it away. So this is our low. We've swept the hourly low. We've then So I'll show, hopefully there's a loss in here that I can show as well. If there is, cool. Right, so let's say we've taken this low. Oh no, there isn't, my bad. So we're looking at, now we've taken this low, we're looking at a breaker structure. Have we got a breaker structure here? High, no. Next high, have we got a breaker structure? No, because the candle has not closed above. Keep down, down. Got another high here. Have we broken structure? No. Next high, nope. Next high, nope, because our next high is here. Have we broken structure here? Yes, we have. So, what are we looking for now? We're looking for a fair value gap. And what is that? Tiny fair value gap there. Pull that out. As you can see, respected. And these are literally just random charts that I'm entering as well. So you can see the power of them and how prevalent they are in Forex, especially as they tend to be even more powerful in indexes. So you can see here, this would have been a really nice trade. Would have probably, as the stop loss is so short, would have looked for an internal high, which is here. So you can see here, we've pushed up. We wouldn't have got entered in because obviously that's our fair value gap. We wouldn't have placed our limit until this candle closed. So you can see we've got a massive push up, and then we've come down, entered this fair value gap, which is what our limit order is. We place a limit order here, and then we've targeted this internal high as our take profit. As you can see, we've smashed up and taken it. Even if we'd taken an hourly high somewhere, wherever we were in here. Let's say even if we've taken, this internal high or this high, they all would have worked. This would have been a 13 RR trade if you just held until the main 1 hour high, which is also in a fair value gap. So you wouldn't really want to hold it more than this. But, this is a 13 RR trade. You're taking profits at here. You could be making 4 or 5% from that trade, and all you've used is liquidity and fair value gaps. So I hope you enjoyed this video. The next video will be on order blocks. These are obviously, as I said, more prevalent in Forex, but still really useful. And obviously, you want to have all the concepts in your locker so you understand everything that price is doing, and then you will choose which concepts you tend to like or don't like and work with them. So yeah, I hope you enjoyed this video.